Welcome to Killik Co's Wealth Planning video. Today, Sarah Lord, Managing Director of Killik Charter Financial Planners, will be discussing the end of the tax year, what it means, what financial investment preparations you should make, and future changes that may impact your plans. Sarah, you're a chartered financial planner who works with a range of clients on investment and wealth planning. As the end of tax year approaches, what does a typical investor need to consider?
As we approach the end of the tax year, it is often a good time to review the structure of your wealth and in particular ensure that you have maximised all the tax planning opportunities available to you before the 5th of April.
What's the main financial planning item to consider as we approach the end of the tax year?
Capital gains tax exemption is the annual tax-free allowance that every individual is entitled to for the current tax year. This is set at $10,600 for individuals and $5,300 for most trustees. Therefore, if you crystallise any capital gains within your investment portfolio up to this value, you will not be subject to any capital gains tax. If you have gains within your Killik Co account which you have not yet realised, now may be a good time to consider whether you should lock in these gains to make use of your annual exemption. Our brokers will be able to advise you on the best way of making use of your annual capital gains tax exemption.
So you'd recommend using this annual allowance to realise some investment gains without incurring taxation on them?
For some investors that might be the right thing to do, but I'd advise discussing it with your broker first. One way to use your annual capital gains tax exemption is to fund this tax year's ISA allowance if you've not already done so. The maximum which can be subscribed into a stocks and shares ISA by anyone over the age of 18 in the current tax year is £11,280. Therefore, a married couple is able to invest up to a total of £22,560 in ISAs for the current tax year. ISAs are available to all UK residents over the age of 18. The primary benefit of an ISA is tax efficiency. You do not pay capital gains tax or income tax on the proceeds from an ISA. And flexibility, as there's no restrictions as to how long you have to hold an ISA for. From next tax year, 6th of April, the ISA allowance is set to increase to £11,520.
On the subject of ISAs, can you tell us a little about the Junior ISA?
Junior ISAs were first introduced on the 1st of November 2011 as a replacement for the Child Trust Fund. The Junior ISA provides parents and grandparents with an excellent way of saving for children. In the current tax year, it's possible to pay up to $3,600 into a Junior ISA for children who do not already have a Child Trust Fund. For children that do have a Child Trust Fund, it is not possible for them to also have a Junior ISA. However, the annual savings limit has increased to be the same as that of the Junior ISA. So if you're looking to save for your children or grandchildren, the Junior ISA is an excellent way to do so. It's worth noting that a child can only have one Junior ISA. Killik Co offer a Junior ISA into which you can save for your children or grandchildren.
And what about pensions? Is there anything investors should be planning for there?
Last tax year saw the introduction of new pension contribution rules, which allow you to carry forward any unused allowances from the previous 3 tax years and receive tax relief at the highest marginal rate. At the same time as introducing the new carry forward rules, the government reduced the annual allowance to $50,000 per tax year. The annual allowance is the maximum total gross pension contribution that can be paid into a pension in a tax year and benefit from tax relief at your highest marginal rate. The annual allowance includes any contributions that your employer may make on your behalf. However, the carry forward rules means that it's possible to pay up to $200,000 gross into a pension in the current tax year and benefit from tax relief at your highest marginal rate. For a 50% taxpayer, this could mean that tax relief of up to $100,000 on a gross contribution of $200,000. For those that are currently additional rate taxpayers, i.e. pay tax at 50%, there is a window of opportunity in the current tax year to receive tax relief on their pension contributions at 50% before the additional tax rate drops to 45% on the 6th of April. At Killik Co, we believe that pensions remain an excellent way of saving for retirement, as they provide the benefit of tax relief at your highest marginal rate. A SIPP also gives you flexibility of not only when you take the benefits from your pension, but in what form. If you'd like to know what the maximum tax relievable pension contribution you can make in the current tax year is, please contact your broker or Killik Chartered Financial Planners.
Do you have any advice for people looking to improve or increase their pension investments to take advantage of the current legislation?
Alongside legislation, pensions need to be tailored to the individual and their circumstances. So my advice is always that a good first step is to contact your broker or the Killik Co new client team. They may recommend the Killik Co SIPP, which is an extremely flexible pension product that enables investors to maximise tax allowances.
And is there anything else that it's important for investors to be aware of as the end of tax year approaches?
If you've maximised your ISA and pension allowances, or are just looking for an alternative investment which still benefits from tax relief, then you may wish to consider making an investment into either a venture capital trust, known as a VCT, or enterprise investment scheme, known as an EIS. Both schemes are designed to encourage private investment into small businesses that need to raise capital in order to grow, and they do so by offering a range of tax benefits to the private investor. In the current tax year, it's possible to invest up to $200,000 into a VCT and £1 million into an EIS and receive tax relief of up to 30%. By their very nature, VCT and EIS investments are high risk, so they will not be suitable for a lot of people, and there is a plethora to choose from. Therefore, careful consideration should be given before making such an investment. If you would like to discuss whether investing in a VCT or EIS is right for you, please contact your broker or Killik Chartered Financial Planners. Finally, another often overlooked tax planning opportunity before the end of the tax year is to make use of your annual exemption in respect of inheritance tax planning. This is the amount that you're able to gift each tax year that is exempt from inheritance tax. This is currently set at £3,000 per tax year and applies to one gift or a number of gifts up to that amount. It's also possible to carry forward the previous year's allowances, so if you did not make use of your allowance last year, you can make use of it this year and gift a total of £6,000.
This video has given a brief overview of the tax planning opportunities that exist before the end of the tax year. Should you require further information or wish to discuss your personal financial planning requirements further, please contact your broker, or if you're new to Killik Co, contact us on the details to follow.